This is one of my favorite topics because understanding a simple concept can solve a really big and a really common problem, which is misunderstanding how RRSPs and corporations should work together. The fact is that incorporated physicians often receive conflicting advice about the RRSP, and this leads to all kinds of unnecessary confusion, tax inefficiency, and even delayed financial independence. Some physicians are told that once they incorporate, the RRSP becomes less important. Others are advised to retain all of their surplus income inside the corporation and invest there instead. These recommendations are usually presented really confidently, but without a clear comparison of your options. Today, we're going to clear up the confusion. For context, I'm a retired physician who faced this issue myself. But now I work as a flat fee certified financial planner. I help Canadian doctors evaluate these decisions based on objective evidence without commissions or product sales. And I can tell you, the RRSP versus corporation question comes up all the time. To see why the RRSP remains important after incorporation, consider two physicians, Alex and Sam, who are at the same stage but receive different advice. Alex and Sam are both recently incorporated, both earn $370,000 a year through their corporations, both want $180,000 available for personal spending after tax, both generate RRSP room. Sam is advised to retain as much income as possible inside the corporation and invest there, leaving her RRSP room unused. Alex, on the other hand, is advised to continue filling his RRSP. The key is to compare how much money Sam and Alex have to invest after meeting the same spending needs. Sam follows the advice that she got from her accountant and retains and invests as much as possible inside of her corporation. She's got active business income, her billings of $370,000 a year. She takes $300,000 in compensation from her corporation. Let's say she has a personal tax rate of 40%. This will be the same for both Alex and Sam. So she pays $120,000 in taxes on her $300,000 of compensation, which leaves her with $180,000 to spend after tax. She also then has income retained in the corporation of $70,000, but she needs to pay tax on that. Depending on the province, that averages about 12%. So 12% tax on $70,000 is $8,400. So the net amount that she has available to invest in her corporation is $61,600. And of course, she has zero RRSP contributions. Alex, on the other hand, decides to use his RRSP contribution. Just like Sam, he has active business income of $370,000. He takes $340,000 of compensation because he makes an RRSP contribution of $40,000. That RRSP contribution is fully tax deductible. So that means that his taxable personal income is $340,000 minus the $40,000 RRSP contribution. So he has the same taxable income as Sam at $300,000. He also has the same personal tax rate as Sam of 40%, which means he pays $120,000 in personal taxes, leaving him with the same amount to spend as Sam as well of $180,000. Alex has income retained in the corporation of $30,000. He pays the same 12% tax on that, which is $3,600. So the amount that he is available to invest in his corporation is $26,400. compared to the $61,600 for Sam. But don't forget, Alex also has $40,000 to be invested in his RRSP. So this is the key. Alex has $40,000 in his RRSP plus $26,400 in his corporation, which equals $66,400 to invest. Sam, on the other hand, only has $61,600 to invest in her corporation. Despite identical incomes, identical spending, identical personal tax paid, Alex has $4,800 more to invest than Sam. And that's just in a single year. If you remember nothing else, this is why investing in your RRSP is almost always superior to investing in a corporation. because of the RRSP tax deduction, you have more to invest and compound over time. Whether you're incorporated or not, RRSP contributions are made with pre-tax income. It's kind of like the government is loaning you the taxes that you would have paid so that you can invest them. In Alex's case, $40,000 of earnings moves through the corporation into his RRSP without corporate or personal tax. That amount is invested in full. Sam has RRSP room available but chooses not to use it. As a result, all of her retained earnings are taxed before investing. This is just math. This is not opinion. But for a deeper dive, the advantage of the RRSP is well documented in the work of Jamie Gollenbeck, for example, from CIBC in his paper RRSPs and TFSAs, Smart Choices for Business Owners. And from PWL Capital, Ben Felix's paper, A Taxing Decision Determining the Worth of Registered Accounts for Owners of Small Business Corporations. In that paper, he says explicitly, the advantage of using the RRSP comes from both the initial income tax deferral and tax-free growth of investments inside of the account. It's true that RRSP income will be taxed as regular income when it's eventually withdrawn, but this is overshadowed by the initial tax deferral and the tax-free growth. For Alex and Sam, the difference isn't just $4,800 per year. Investments inside an RRSP grow without annual tax on the investment returns, on the interest, dividends, and capital gains. Corporate investments, on the other hand, are taxed annually with only partial refund of those taxes later. And that ongoing tax drag reduces compounding. So even though RRSP withdrawals are fully taxable in the future, the combination of a larger starting balance and tax-free growth generally produces higher after-tax outcomes than investing solely inside of a corporation. Dividend taxation at withdrawal from a corporation may be a bit lower than RRSP withdrawal taxation, but it doesn't offset both the initial tax paid and the ongoing tax drag inside of a corporation. So what are the consequences of not using your RRSP? Well, when RRSP room is left unused in favor of corporate investing, number one, less money is invested each year for the same level of spending. Number two, more tax is paid up front than necessary. And number three, long-term compounding is reduced, resulting in less long-term wealth. But there's one more issue that receives less attention, and that's tax risk. Corporate taxation has changed repeatedly over the past several decades. If the government needs money, it's far more likely to target corporations than registered accounts. So concentrating long-term savings inside of a single structure increases exposure to future rule changes. Using RRSPs alongside a corporation spreads that risk across different accounts. It reduces the dependence on any one set of tax rules remaining constant and favorable over time. So in summary, there are a few important lessons that we can take away from Alex and Sam. Number one, as long as RRSP room exists, it remains the most efficient savings vehicle available to an incorporated physician. Number two, choosing to retain all of your savings in the corporation instead, like Sam is considering, increases your taxes paid up front, reduces the amount invested, increases ongoing taxation, and increases regulatory risk. And finally, incorporation is beneficial for both Alex and Sam. I want to be clear about that, because they can save enough to both maximize their RRSPs and retain investments in their corporations. But if they only had enough to fill their RRSP, incorporation wouldn't actually be worth it. In the next post, we'll look at a source of confusion that's related to this RRSP issue. The common recommendation to take only dividends after incorporation, eliminating RRSP room creation altogether, and why that advice usually produces worse long-term results.